Partnering with us today to discuss the Canadian banking space is Hamilton ETFs. And Hamilton is one of the fastest growing ETF managers here in Canada with over $2.25 billion in assets under administration. And it is one of the country's largest ETFs in the financial services space. I am thrilled to be joined by Rob Wessel. Rob is the managing director. He's a co-founder at Hamilton ETFs, and he is recognized as one of the leading banking experts here with over 25 years of experience. He specializes, as does Hamilton, in the financial services space. And Rob is a former number one ranked Canadian banking analyst. So Rob, welcome to the program.
Oh, thank you so much. Glad to be here.
Yeah, it's nice to have you and your insights today, and I know our audience will be keen to hear your thoughts. I want to get into that very soon here. First, although I just want to tell our viewing audience here that you do on your website provide frequent and timely updates in the financial services sector. So I'm going to put a link to the video here, and these insights can be found on your insights section of your website at hamiltonetfs.com. Rob, I'm going to be asking you in the interview today for your thoughts, for your insights into the banking sector specifically, and looking forward to hearing your overview, your thoughts on what the key opportunities might be out there in the space today. Also, as always important, the key risks in the Canadian banking space going forward. So we'll get into that. I do know that you very recently launched a new fund, HEB, I believe is the ticker. I wonder if you could just tell us a little bit about that.
Yeah, so just earlier this month, we were pretty excited. We launched the Hamilton Canadian Bank Equal Weight Index ETF, and as you mentioned, the ticker HEB. At 19 basis points, it's going to be the lowest fee Canadian bank ETF in Canada. It also will start out being quite large. By month end, it'll have about 500 million of assets under management. We are the number two provider of Canadian bank ETFs with AUM of over $1 billion. So we're pretty excited to add this to our product suite.
Nice. Well, I know a lot of the audience are excited to learn more about the new fund. I have a number of questions I want to ask you today specifically on the banking sector. And I'm just going to go back a year. 2022, obviously, Rob, was a rough year for equities in general, but certainly in the Canadian banking space as well. We saw what I would call quite a strong comeback early in 2023 and maybe thought the worst was behind us. But since mid-March or so, the markets have corrected again. And I'm curious to know, in your opinion, what the main reason or maybe some main reasons for that pullback that we've seen more recently.
Yeah, so I mean, everything was going quite well from, in the recovery, post-COVID recovery, if you will, into 21. In 2022, obviously, once inflation started to emerge and central banks concluded that it was not transient, what you saw rather abruptly was the market pricing in essentially a recession. And so it's true that the banks were only down 9% last year in 2022, but that stat's a bit misleading because it masks a larger correction. As we all know, the sector did fall at one point, peak to trough, over 20%. So, the real question is, for the market, was this emergence in inflation is they've discounted valuations, and, it's kind of a combination of a few things, whether it's rising interest rates, the risks of normalizing monetary policy or just greater uncertainty. There's no question that right now, at current valuations, the market is pricing in a lot of bad news.
Mm-hmm. Yeah, you talk about the recession, and I am going to ask you a little bit more about that in just a few minutes here. But I think what you're saying is, in general, it's a bigger part of the whole, the issues that the whole markets have been experienced over in the last little while. The timing of this discussion here is, I think, good because about a month or so ago, I guess we just came through earnings season, and all of the major banks here in Canada have reported. With the latest reports, and I know in your work you're scouring those reports, what would you say, Rob, jumped out at you the most, or what are something that investors should be aware of if you're an investor in this space?
Yeah, so it's actually quite interesting. Last quarter, and even the 2 quarters before that, but let's use last quarter, the fundamentals were quite resilient. I think, with all the bad news and all the press coverage, it's kind of helpful to step back and say, well, what did they actually report? So ROEs were over 15%. Earnings was about $15.5 billion, near all-time highs. It was actually up $1 billion from the previous quarter. Credit, which is obviously very important, was benign. Capital markets, which is a very, very important revenue source, was also improved. And net interest income from lending was basically flat. So notwithstanding the pretty severe valuation discounts that they're facing, if last quarter was pretty encouraging if you are focusing on what's actually going on and what they're actually reporting.
This could be one of those scenarios where it feels worse than it actually is,
Mm-hmm.
because there's just sort of this overwhelming, almost like a negative sentiment. But what you're saying is when you actually look at the numbers, they're rather encouraging.
So far, yes.
Yeah, so far. You mentioned valuations, and I know we saw at the end of 2022 some attractive valuations, and then with the recent pullback, we've seen those multiples, getting back into an area where they might be garnering some more attention there. You, I think, might have just touched on this, but do you feel right now that the markets are pricing the banks correctly, or what are your take on that?
So I think it's interesting. So just to be more specific, so Canadian banks trade at less than 9 times forward earnings. So that's well below. That's a steep discount to its longer term average. So I think, whether the market is right or wrong, I think I'll answer a different question. I think it is fair to say that the analysts, I think, are forecasting a hard landing, and the market is forecasting an even harder landing. So I think, in our opinion, when you look at 9 times forward, that's really the market pricing in, call it a 15% decline in EPS estimates going forward. And we just don't think that's very likely for lots of reasons that we can talk about in the rest of the conversation. But at the end of the day, and not to get too detailed or get too boring, but it is relevant, is that the analysts are forecasting total loan losses for 23 of about $12 billion, give or take. In Q1, they reported about $2 billion, which annualizes to 8. It does not annualize to 12. So the current run rate would suggest that credit is going to be not as bad as the analysts are forecasting, or even the market for that matter. So, right now I would say history has been very kind to people who bought the Canadian banks at less than 9 times forward. You don't get these valuations when there's sunshine and rainbows. You get these kinds of valuations when there's storm clouds. The question, not to give a crude metaphor, is essentially, are those storm clouds severe enough to impact the foundation of the sector, whether it's capital or earnings? And in this case, we would say, we feel that nine times forward is heavily discounted, and we think probably represents a very good risk reward.
I would have to agree with you on that. And this is one of those things, as a veteran in the industry, where there's the math, but then there's also a bit of the heart and the head sort of comes in sometimes too. And you have a feeling where things just aren't exactly where they should be. So that is insightful. A question for you, Rob. I know that in your suite of funds, you guys have, like I say, you have a heavy focus on the financial services space. If you are looking in the Canadian space right now, where would you sort of say would be a well-suited type of fund for Canadian investors, given the conditions we're in these days?
Yeah, so everybody has their own individual circumstances, and they should consult with their own advisors and think what they need. I think if you're not looking for strictly income, but you're interested in getting exposure to the Canadian banking sector, one of our products that we quite like is the Hamilton Enhanced Canadian Bank ETF, ticker HCAL, which we advertise on BNN, and some of your viewers might be familiar with. It's the top performing Canadian bank ETF since inception. It does have a little bit of leverage, 25%, on a portfolio of equal weight Canadian banks. But I would point out that even though it has a little bit of leverage, 25%, the volatility profile is not meaningfully different than an individual Canadian bank. So if you're okay buying an individual Canadian bank from a risk perspective, you should be pretty comfortable buying HCAL. And it does, by the way, yield about 7.5%. So you do get paid to wait, and those are paid monthly. But the key here is, are you a long-term investor, or even a medium-term investor for that matter? Because there's quite a bit of uncertainty in the market right now. But as I said, history has been kind to people who are long-term investors. Maybe what I would say, Mark, is the more gray hair you have, the more likely you are to feel confident that they're going to recover, and maybe look through some of the noise and some of the headlines. And we think this is a very good vehicle for that.
So what you're saying, Rob, is I should feel very, very comfortable, given my volume of gray hair here.
I have quite a bit myself.
We can feel comfortable there. You mentioned recession, and obviously, if we go into recessionary times, whether it's a deep recession or mild recession, it's not good for the markets in general, not good for the banks. If I heard you correctly, you're saying that the markets are sort of, the general pundits are saying we're going to go into I think you said a deep recession, and the markets are pricing in an even deeper recession. If I'm
Yeah,
accurate,
the analysts, I think it's fair to say, with their loan loss assumptions, are pricing in a hard landing.
right. Do you, if you don't mind, I'd like to ask you, what is your take on that? Are you in line with that, or do you? I mean, there's also this option of a mild recession. I'm not accepting there will be no recession. I think that
Yeah.
the evidence is just too strong against that. But assuming it's mild or deep, one of these, what as an investor in the Canadian space, what should we factor into our decision making, and what type of investments we should hold?
Yeah. So just on whether recession will be mild or deep, I mean, we're not economists. We go with consensus, but we do say, okay, well, what is the sector trading at, and what is the consensus economic outlook, and is there something that we think is relevant to reconcile those two? And I think for us, the key is that the analysts are being extremely conservative on loan losses and pricing in a hard landing. So a hard landing is more or less the worst case scenario, and I think that's already built into valuations. Having said that, let's say for the sake of discussion, so in the previous question I mentioned HCAL is a very good vehicle to participate in the eventual recovery of the sector, but there's no question there's lots of people who would be very worried about a deep recession, or they might be worried about just an extended period of high volatility and just mediocre returns in the markets period. And sometimes in that type of market, investors like to look to covered call ETFs, which can have a bit lower volatility in terms of their stock prices, but in a period of high volatility, it helps them generate higher yields. So we do have a product for that. We have the Hamilton Canadian Financials Yield Maximizer ETF, ticker HMAX, which is a Canadian financials covered call, but it's 75% Canadian banks. It has about a 14% yield. I know you've talked about it in a previous video.
I did.
We do have an active at-the-money covered call strategy. So we try to maintain at least 50% to upside potential, but there's no question there's a yield return trade-off in covered call ETFs that everybody is familiar with. This has been a highly successful launch. It's raised over $200 million in just 11 weeks. So it's it is the most successful launch in Canada thus far. But if you're looking for a period where you think the market is going to be fairly mediocre and or high volatility, and you're very focused on monthly income, then HMAX is something that would be appropriate for a certain type of investor.
Yeah, I obviously I do like that fund, as you mentioned, Rob. I do have a previous video on that with that very attractive yield. Actually, maybe I'll put a link on the screen here if people want to check that out more. But you've got the leveraged the HCAL with a 25% leverage in it for not as income focused, more of the growth potential, but also the yield on that is higher than you'd get just by going out and buying the banks. In any event, but I want to go back just for a moment to we talked about the banks reporting, and one of the numbers that we always look for with the banks, and especially in light of what's been going on south of the border, are the CET ratios or the common equity tier ratios.
Yeah.
In 2022, I mean, I've been comfortable for the last decade or so that our Canadian banks have a very solid coverage there. OSFI did raise the requirements back in 22, if I'm not mistaken. And my question to you is, in your opinion, where's the balance there? Have they gone too far? And having a negative effect on the earnings is a real opportunity there, or do you see it as being just a prudent move that that the regulators have taken here?
I think it's fine. They did, as you mentioned, Mark, increase the stability buffer, which precipitated an equity raise for BMO. Capital is what made so our firm and anybody who's been following the sector for a long time knows that CET1 ratios are significantly higher, or capital is significantly higher than it was, say, when I started in the Canadian banks nearly 30 years ago.
Right.
But I think it's fine. We've written that it's fine. But if that's unfortunately for what I think isn't relevant is, does OSFI think they're fine? And if OSFI thinks they're fine right now, and we can only assume that they do, then this is really a non-issue. But if OSFI in the background is thinking, we want to drive capital higher because we think it might moderate home price increases, or we're just generally worried, then the fact is that will precipitate either more equity raises or a period of slower growth as the banks sort of try to build capital internally. But I don't think this is going to be a big issue, but it is But it's a good question, and we wrote about it in our opportunities and risk note in January, which is if you think about what the opportunities are in the sector, which we talked about, you think of what the risks are. In the background, higher regulatory risk, in particular capital, is definitely something to keep on your radar screen.
Yeah, it is one of those sort of down if you do, down if you don't, because you want to have the security of those strong ratios. At the same time, there is that tipping point, right?
Yeah.
So appreciate your insight on that. As Canadian investors, I just want to sort of shift over here to something near and dear to a lot of Canadians, are mortgages. And obviously a lot of the big banks, all of the big banks, I would say probably here have a pretty substantial mortgage block on their books. With interest rates having risen, there's chatter, there has been now of a housing slowdown. Obviously that probably would affect the banks. Most recent Bank of Canada decision was to just hold rates where they were. Question to you, Rob, is do you see that decision to hold the rates as sort of a relief to some of the worries that we might have as Canadian bank investors, or do you see sort of more potential issues coming down there with a more a broad housing slowdown?
Yeah, so we can have a whole separate video on Canadian housing, but I think just to try to keep it tight or short, I think there's a couple things. The first is with immigration at high levels and population growth at high levels, it does make it difficult for home prices to fall a lot. For example, the province of Ontario added about 500,000 people last year.
Right.
That's a lot of people who need homes. And I think that's, this is one of the dynamics that's kept home prices higher and really, quite frankly, frustrated all of the housing bears. But let's say, for the sake of discussion, home prices do fall a lot. Let's just say 25% in a short period of time, if we want to be hypothetical. It's not really going to do much to the Canadian banks in a direct way. It doesn't really result in loan losses on mortgages. And that's because, as we all know, if you have a high ratio mortgage, the government requires you to self-insure against your own credit risk. Therefore, those losses are borne by CMHC. And so you end up with the negative impact ends up being indirect, which is it's a slower GDP growth. Is it ancillary losses in other categories like construction loans and commercial real estate and credit cards and things like that. In terms of the recent Bank of Canada decision to hold rates, I mean, obviously it is at the margins. If you're worried about housing risk in particular, it is a positive. But I think, we've been talking, and I know you, Mark, have probably been talking about housing, Canadian housing and the banks for probably at least 15 years. It wouldn't surprise me if this is an issue long after I've retired, because home prices in Canada are high. And they're not coming down, or they haven't come down. But as it relates to bank investments, I think there's lots to worry about that I think are more important near-term risks and possibly more significant risks than home prices.
While you were speaking there, Rob, my mind was going to what you just said, and that, like, as long as I can remember this, the mortgage issue, the housing issue is always part, and it is a big part of our financial system. So you kind of beat me to the punch on that with that answer, because we're thinking along exactly the same lines there. I want to shift to dividends just for a moment, if I could. And I know that in your suite of funds, dividends obviously play a big role. And our banks here are sort of famous for their reliable dividends that increase on a regular basis. And it's pretty easy just to assume that what's happened in the past will continue into the future. And I know I don't worry very much about the Canadian banks paying their dividends. For the most part, they're pretty much on schedule there. I would be interested in your thoughts there, and just if we talk about the dividends that Canadian banks pay, just in general, or is there anything that you feel that an investor, just as part of due diligence, should be aware of when it comes to the reliability and the attractiveness of the Canadian banks paying the dividends?
Yeah, so that's a good question. I think I would point out two things. The first thing is, I mean, outside of one bank in 1991 reducing its dividends, there's almost no institutional memory of anybody cutting their dividends except for that. Certainly long before any of us were either born or cared. And I think the reason for that, I think, is actually important, which is the Canadian banks, when they suffer large losses in the past, which they have, they've tended to issue equity rather than building capital through cutting dividends. So it's not like they've never needed capital, but they've typically not tried to raise it through reducing dividends. So the big takeaway here is, especially in light of your earlier question, where capital ratios are extremely high, this seems to take the risk of reducing dividends. I mean, as I used to say when I was a bank analyst, the risk of them cutting their dividends is as close to zero it can be without being zero. So that's the first thing. The second thing I would say is when you think about their increase, this is probably the more relevant point to your audience, which is generally speaking, growth in dividends tracks very, very closely to the growth in core cash earnings. And so because core cash earnings, you're in a relatively slow growth environment, I think it's realistic to assume that growth in dividends will be fairly muted for the foreseeable future. They'll go up in the semi-annual, but they're not going to go up a lot.
Okay, yeah, good comments on that. And I think back to, the I didn't realize 1991 was the last time that we saw an actual cut. We've seen some pauses, regulatory driven, not from the banks themselves. So good. Yeah, and like I said, Rob, I'm very comfortable with the dividends that the banks pay, and like I say, I just kind of assume they're going to continue, all else being equal, to raise those. I know we're talking here today specifically about the Canadian banking system, and that's where your specialty is. But I just got to say, it probably would be remiss here if we didn't talk about the recent events down south of the border with the implosion of SVB and Signature Bank and First Republic and all the issues they've been having there with those regional banks. Quick question, I guess, Rob, is what is the biggest impact that you feel that would have here on our Canadian banks? And is there anything, quite frankly, that we need to be worried about? Do you see that continuing to spread? Or are we under control there?
Yeah, so there's a couple takeaways. Obviously, this was top of mind certainly 3 weeks ago or 3.5 weeks ago, give or take. I think as it relates to the Canadian banks, I think I would probably point out a few things. The first is that as it relates to, let's say the next 2 quarters, I think don't be surprised if the Canadian banks report that their U.S. platforms, so the biggest ones being obviously TD and BMO, got a spike in deposits because they benefited from a flight to quality. As corporate accounts across the United States figured, well, wait a second, maybe I don't want to be in a smaller bank, and I'm going to go to a bank that's too big to fail. The Canadian banks are almost by definition too big to fail. So don't be surprised if they get a benefit from that. Don't be surprised if in that period of heightened volatility, trading revenues go up. So that would kind of be the near-term good news. Having said that, it's hard to believe there won't be a regulatory response in the United States, whether it's building liquidity ratios, which could weigh on net interest income or net interest margins, which could weigh on ROEs. So, this is an important development. We'll see what happens. But I mean, at the end of the day, probably a bit more for TD and a bit more for BMO, less for RBC and CIBC, and then obviously it doesn't really affect Scotia at all. But I think those platforms, if you had to go, say, 3 to 5 years, are probably going to make a little bit less money than they would have otherwise. But I don't think it's going to move the needle for investors today. And the banks are great at adapting.
Good point. Adaptation is huge, and I like getting your insights on that because I'm out there. I own Canadian banks like most Canadians who invest in the space do, either directly or indirectly. So I
think I'd also point out for your audience is Silicon Valley Bank, and I won't get into the details, was a deeply idiosyncratic set of circumstances. It was almost this unusual company hitting a perfect storm of negatives that obviously shook this confidence in the sector. Signature was more about crypto and the government not really wanting to, facilitate crypto transactions or just the popularity of crypto. But so when you think of Silicon Valley Bank, it's not really relatable. Gotcha. It wouldn't look anything like your average generic US bank, and it certainly wouldn't look like your generic subsidiary of a Canadian bank. So I think it did roil the market for sure, but there's very few, there's nothing, in fact, of any relevance or significance that you would take from Silicon Valley and think it was directly applicable to the Canadian banks.
No, good analogy or good comparison there. And I know, well, I believe that at some point in the not too distant future, it'll be like, remember SVB, and it'll be one of those. And I know you've been in the business long enough to remember Barings Bank, way back in the day. It seems like, it was the big news, and a lot of our viewers won't remember. Is it Nick Leeson, I think, right? Who was
that's right.
The culprit there. So anything can happen overnight, but that was a good bit of history there. Rob, I really appreciate you taking the time to come on to the program today and visit with me here because, like I sort of alluded to, a lot of our viewers, a lot of Canadian investors have money put into this financial services
Sure.
space, the Canadian banks. And I know you, again, because Hamilton is so focused on that space that you're right up to date. So appreciate you coming on and sharing your thoughts, your wisdom with us all. I will, for Hamilton ETFs, as I said, you guys are big in this space. I will put a link in the description below, and I invite our viewers to go ahead and check out the funds in more detail there. And as I said at the outset, you have your insights that you have on the site there. So that's a good way to keep up to date as well. So I'll kind of log off here, Rob, unless there's anything else sort of you want to wrap up with.
No, we really appreciate the opportunity to speak to your audience.
Good. Well, thanks. And yeah, so we'll wrap it up there. As always, I will put a link also for our Investing Academy in the description below. And Rob, thank you for joining me. Thank you all for watching the video, and look forward to seeing you in the next video.
No, my pleasure.